Welcome to Investing Insights, partnered by Right Property Group. This is your host, Phil Tarrant.
G'day everyone, it's Phil Tarrant here from Smart Property Investment. Thanks for tuning in. I'd like to welcome you back to our key education series, Investing Insights, which we do with one of our key partners, the Right Property Group. Got the boys in the studio again today, Victor Kumar and Steve Waters. How you going, guys?
Good mate.
Phil.
How are you?
Really good. This is now the fifth one that we've done of this. So being up
Flying through
5 months.
Yeah.
Wow, they're quite popular as well, which is good.
Been awesome.
Yeah, really good. If this is the first time you've tuned in, thanks for joining us. So I guess what we're trying to achieve with this is very different from the Smart Property Investment Show, which where we chat to investors and get their stories. Our Investing Insights podcast is very much geared towards looking at some really deep issues surrounding property investment. So the Smart Property Investment Show doesn't really allow us to deal with some pretty full-on issues that we need to give a lot of time and attention to. So we hope to cover off over the next half an hour a very key topic, which comes to investing in property. The previous ones we've done have been pretty good and really interesting. You'll probably see them if you're listening to this on iTunes. You'll see a list of them underneath it, or on our website, all the other topics, but I'll run through them really quickly. Topic 1, the first one we did was 11 things successful property investors don't do, which was really interesting. Topic 2 was debunking the most popular property myths. Topic 3 was mindset, goal setting, that sort of stuff. Topic 4, our most recent one, was investing in units versus houses. So should you choose one over the other? Today we're going to tackle a big issue, one which any property investor who's been in this game for quite some time will be talking about. And if you're new to property investing, this is something you should be thinking about now rather than in the future. And it's all about building a balanced portfolio. A balanced portfolio is going to mean very different things to different people, depending on property investment journey, how far through you are in it, the assets that you might have in your portfolio now, what your goals are. But let's just tackle off a really easy question straight off the bat. Victor, to you, what does it mean? What's a balanced portfolio?
Thanks, Phil. Well, if you look at an investor and if they're starting a portfolio, often they get skewed down one area or one method of investing without adjusting for market, without adjusting for their increasing or decreasing negative cash flow as they are building the portfolio and accommodating for life events. So there are quite a few things we need to look at when we're building a property portfolio, such as where the properties are located, so you're spreading them out nationally or even internationally, looking at spreading the lending out, spreading the risk in terms of the types of properties you buy and so forth. So there's a lot of things that need to be taken into account as you continually build on the portfolio.
So when most people who have any experience or education in investing, when they hear the term balanced portfolio, what will normally spring to mind is a balance in asset classes. So people will be going, well, if I'm looking to create wealth for retirement, say for example, a balanced portfolio would be to have some property, have some shares, some fixed income, some savings, maybe some fancy bottle of wine, which I'm sure Steve's got in his balanced portfolio.
Hardly. You got him before I could.
So that's how most people would conceptualise a balanced portfolio about asset classes. But what we're talking about, I guess it's similar in some ways in that you have a balance of the type of assets you have in a property portfolio.
Pretty much so. So if you brought it back to, say, shares as an example, you would be investing in different companies, shares of different companies. And it's the same with property as well. You're investing in different areas. So you look at it as different businesses. So as an example, those that have invested recently in New South Wales, particularly in Sydney, they are investing more so for the equity because the yields are no longer there. So they need to then further diversify, in other words, balance their portfolio by getting some yield to help support their equity gains. And that may be in other states where the yields are significantly higher and the entry prices may not be as high.
For someone new to property investing, Steve, when should you start thinking about building a balanced portfolio?
Before you do anything, really, it should be the first step. And quite often we see people that they want to attack the whole balancing act somewhere toward the end of the portfolio or halfway
as an
through.
afterthought.
Yeah, when they're in trouble, they think, well, we probably should have done this a little differently. To me, balancing a portfolio, it's really covering my risk. That's how I think about it. And as you know, I'm quite conservative and I don't go into anything looking for the negatives, but I just want to know that I can sleep at night, and that if I have everything right, and that's in terms of equity, as Vic mentioned, and also cash flow, then my worst possible scenario is covered. Well, it should be. Too many people don't do that, unfortunately. And Vic just mentioned about cash flow, like people are coming into New South Wales, or they're still investing in New South Wales, Sydney in particular, more about growth and instant equity and not cash flow. And I was having a conversation the other night with someone who was saying, well, we want to invest in Melbourne for cash flow. And I said to him, look, well, Melbourne's perhaps not the place to go for cash flow. And we had a very in-depth conversation all around about cash flow, which is part of the Balancing Act. And my point is, everybody who talks about cash flow can't really define what cash flow is. What is their version of cash flow?
That's right. So it's different for everyone.
Well, it is.
Yeah.
And if you go south of the border and perhaps they might get, say, a 4.5% or a 5% yield, for them that's awesome. That's cash flow. But for us, a 5% yield means, well, that's not really cash flow. It has to have something else attached to it, whether it's going to be instant growth, instant equity, or something that's got a twist to it. So everyone's interpretation of cash flow is different.
I guess you've got to set the benchmark. So if your benchmark was 4% as a good
Correct.
yield,
Yeah.
then anything above that is fantastic. Whereas if you look at investing in Sydney in the last, say, 5 years, we started off with good cash flow and now we're getting into good equity because, as usual, growth actually follows yield. So we had fantastic yields in Sydney, and now we've had the phenomenal growth with the infrastructure changes and so forth. Of course, the lower interest rates have helped. And now for those that have invested heavily in Sydney, perhaps a balancing act could be that backing on the equity that they've gained, they may now want to invest in another state to get on the upside of that state, because they have had significant gains here and have a higher cash flow there to offset a heavier equity in New South Wales.
So balancing means a whole bunch of different things.
Pretty much so, yes.
Yeah, it does.
Yeah.
So new to investing, or even something I think about was you got to balance the books, right? So from a cash flow perspective, you're going to have individual properties are going to have a different cash flow outcome or implication of your portfolio.
Yeah.
But then when you start having multiple properties, 2, 3, 4, 5, 10, 50, a balanced portfolio might mean that you have different assets within a portfolio, but you could be looking at least towards a neutrally balanced or geared portfolio, or positively geared.
In a perfect world. But as we see prices increasing, that yield is diminishing no matter where you are. And it's not because the rents are going back unless you're in WA, but it's more about the prices going forward. But it's not just about the cash flow. I believe the whole balancing act, so to speak, it's about where your properties are located, for anything from entity to land tax thresholds,
lenders
especially. So it's a whole myriad of things that you should be looking to balance your portfolio.
Well, let's look at those. So from a risk perspective, let's look at balance. So you've got lenders, so you can balance out your lenders. So you're not overly geared towards any particular lender, and therefore you're minimising your risk profile. Should one make changes in terms of interest rates and the other ones don't, you're not overexposed if all your eggs in one basket. So balance out your lenders. Balancing out the type of properties that you have. So houses, units, we spoke about it last time around.
Yep.
Victor, you could probably chat on this. Houses perform differently to units and the other way around, from a cash flow and also capital growth perspective.
Absolutely. So usually it's the units that have the higher yield, and they do come with their own expenses, such as your strata fees and so forth, but they're usually located very close to infrastructure, whereas houses may have a higher negative cash flow, but you've got so many other things you could do to it, such as subdividing the block and so forth. So it brings in its own pros and cons. And if you have a portfolio that's just units, nothing wrong with it, so long as you diversify the area. Or if you've got just houses, again, nothing wrong with it. But with my portfolio and with yours as well, Steve, and for a lot of our clients, it's balanced in the sense that by the time your portfolio is mature, you have a blend of houses, townhouses, units, and small development sites. By small development sites, I mean your simple subdivisions, your granny flats, and those sort of things. So that down the track, you can then look at methods of retiring the debt, which is probably one of the things we'll talk in the upcoming podcasts, and that helps you retire the debt really quickly. And also, if you're looking at it from diversification into different states. So let's say that you had a necessity to sell down your portfolio, part of a portfolio, whether it is to fund a acquisition, a lifetime acquisition, or whether it is for lifestyle reasons. If you have all of your properties in the one state, so let's say someone's got all of their properties in, say, Western Australia right now, it would be a lot harder to sell down and realize a significant gains in there, as opposed to having it spread out. So we'd leave our Western Australia portfolio alone, and we may sell down our Sydney portfolio, which just gives you the choices to change. Yeah.
At the end of the day, I think that's what balancing is about. Yeah. It's about choice, options.
Good point.
Yeah.
So we spoke about lenders, we spoke about housing units, you balance that out. Spoken very quickly about locations. What do you think about balancing out in terms of metro, regional, or rural stuff? Steve, what's your thoughts, mate? I know you're a country boy, and
well, and I've got properties in regional areas, and I think there's a time and a place for them. Usually, when cash flow is nowhere else. I'm a bigger fan of metro areas because that's where the world lives,
and the liquidity is much
there. But having said that, there are some regional areas which do tick a lot of the boxes, but they've got to have their own infrastructure. They've got to have several parts to the economy. They can't be reliant upon, say, the one thing, such as mining or agriculture, as an example, and that they can produce well for you. So a really good example of that is central New South Wales. About 5 to 7 years ago, somewhere around that period, we targeted the Dubbo region because it's probably a major inland city, the biggest there is, and what that was giving to us had the potential cash flow. So at the time, I think it was 8% buy-in yields, which was pretty good. We went to the right areas. And the growth potential was there purely because of more infrastructure. I think it was the Evo cities that was going on back then. And we bought a lot very, very quickly. And in probably 7 years, they've doubled. Now, I'm not saying that's the norm. I'd like to say it's because we bought them well. And the cash flow as a representative back then is somewhere around about 10% now.
Okay.
Yeah. So there's a time and a place.
That's right. So if we took that example, so it does have a very specific place in the portfolio. So something like that you would use to help underpin a more negative cash flow property. So what I call pigeon pairing a property. So let's say you had a property in say Sydney where it's costing you, say, $150 a week in negative cash flow before tax. And you've got the other property in Dubbo that's, say, bringing you in $50 positive cash flow in the worst case scenario before tax. All of a sudden, your holding cost has dropped from $150 to $100, which is a lot more palatable than $150, especially when there is a absolute sure chance that interest rates will rise in the future. So you're using two different types of assets to underpin each other. So one's giving you the yield, the other one's giving you the growth.
And that's probably the main thing that people think about when we talk about balancing a portfolio. It's all about the cash flow, which is is second most important to oxygen because it's survivability, isn't it?
Yeah.
And it not just helps from the money in, money out of your pocket, but also from a serviceability point of view too, if you want to keep perpetuating the portfolio. But all of that aside, and coming back to the regional areas question, it is really, and I know I just touched on it, but it's really about timing. There are certain times, no matter how big the regional centre is, I don't think people should go there. But as a disclaimer, everyone's situation is different. But it's just so important to get the timing right.
Another area of balance, and you touched on this very briefly, Victor, was the opportunities that you have within your portfolio. So you can have a property that you never touch. You just buy it. It's good yield, good prospects, capital growth. Never seen it, sits there, does what it does. Then you have stuff that you might be able to manufacture some equity in, small renovations, cosmetic renovation, maybe something a little bit more significant, or something that you can potentially do a small development on, so knock it down, duplex, granny flat, etc. So you can balance your portfolio by having different opportunities and different assets within it that can give you leverage to grow and evolve and
absolutely.
So can you sort of comment on that very quickly?
If I look at my own portfolio, so I started out buying a unit as an investment, first investment, and that was two reasons. One, I didn't know any better, and I was pointed in that direction, and I had limited capital, and it worked out really well for me. And if I would start all over again, I'd do absolutely the same thing, right? So that's been the cornerstone. And then I've gone on to buy houses, and then small development sites where I could do a subdivision or granny flat. So if I were to then look at opportunity, and as experience grows, I would then go back and do the subdivisions, put in the granny flats, and in a high interest rate climate, I would actually bring forward those secondary dwellings to help me hold on to the property. So it comes back to staging it, whether it's in the different states or whether it is in the different asset classes, and also having a progression plan to say that, okay, I'm going to hold this asset, and I may come back and develop on this, and therefore further balance out whether it is my equity position or my cash flow position, or whether it is something that I'm going to renovate and sell down for lifestyle reasons to fund my lifestyle, or it is just to increase the equity base in my portfolio.
Obviously, we're speaking very general around a balanced portfolio here. So, by way of disclaimer, everyone's circumstances are different, so you should be speaking with the appropriate professional to give you guidance and support and advice. But sort of that aside, and the reason why I say that is because I want to have a quick chat about sort of entity structure, Steve. We spoke about balancing lenders, balancing areas, balancing the type of assets, balancing opportunities. So do you have a balance also in the way in which you hold these properties? So whether I'm investing in a trust or some sort of co-ownership or individually?
Yeah, look, when I first started, my accountant at the time said, well, he stopped me because I wanted to, all I'd read about was, got to invest in a trust, I need the protection, better tax advantages and what have you. And he gave me some pretty good advice that was suitable for my situation at the time. And it was quite simply exploit yourself first. And there's a couple of reasons for that. One, back then, and it still rings true today, is about serviceability or getting finance. Getting finance for yourself is much easier in most cases than doing it in a company format or getting it in a trust structure or whatever it may be. And there was also obvious benefits for me from a land tax point of view. And furthermore from that, he said do it individually, so not with your wife on title as an example. Now sometimes even in today's environment you need to be both earners on the loan, but having one on title can be more beneficial. So from a balancing point of view, it gives you a couple of advantages. Now once again, everybody's scenario is different, but entity helps you in terms of what you invest in and in which entity, whether that be once again personal, trust or company, gives you more diversification, gives you more risk mitigation, and it gives you options once again. But the best people to speak to that is not just your accountant, and it's not just your financier. We always urge people that if you are going to start investing in structures other than yourself, that you actually get your accountant and your broker in the room together, because often what the broker wants to get the loan across the line, perhaps the accountant doesn't, and vice versa. So get them both around the table.
And what I found in terms of in building a balanced portfolio and the way I've approached it, I think we probably made the mindset choice early on that we're going to grow a large portfolio over time, and therefore we need to get this right. But often your structure is going to be influenced by the type of diversification or balance that you have, and I say that by
and your profession.
And your profession. If you work if you're self-employed and you work in quite a litigious type of position or role, like the media, you need to protect your assets differently, and that's going to change the way in which you might want to build a portfolio. But that said, also, the land tax perspective, you can invest, for example, in trust structures up in Queensland and get a threshold on land tax, whereas if you're buying in New South Wales in a trust structure, you get no threshold. So that might influence the balance that you have in terms of how you choose to hold those assets.
That's a mistake we see, and I'll call it a mistake in inverted commas, that often people, when they're first starting without the proper advice, they will create this trust because perhaps the accountants led them down that path, and they just don't realise, especially if they're investing in New South Wales, that they're going to be up for land tax. And
that's probably because the accountant's coming from a tax perspective and an asset protection perspective.
Or revenue.
That's true. And they may not take into account the entire picture. in terms of what's the impact in terms of land tax, what's the impact in terms of lending itself, because not all lenders are comfortable lending to entities such as family trusts and so forth. So therefore you've reduced the number of lenders that you can approach, and also it starts becoming a bit cumbersome in terms of compliance, in terms of getting the lenders to understand how the income flows in your portfolio and so forth. So the idea is to keep it really simple. And once you have, as Steve said, once you've maxed out your own personal threshold and your personal lending, then perhaps look at structures. Of course, we're talking still very general. If it's specific in your needs in terms of having a trust structure put in place, then you should.
We've spoken about what balance means in a portfolio, and I think we've given a pretty good run just generally about the areas where you can get balance. There's also balance in potentially the people that you use to help you grow your portfolio.
Yep, true.
Yeah, absolutely.
You might want to do some stuff yourself. You might want to use a buyer's agent. You might have, an accountant, a financial planner. So, there's another element to that, but I don't want to dig down too far into it. But I guess my sort of question, we're going to have to wrap up pretty quickly, maybe for you, Vic, is how do you know if you've achieved balance? How do you know if you're sort of on the right path? It's like it's like a tantric sort of, I've got balance, or balance in the force, or how do you know you got it?
I was waiting for the music to come on, Phil.
I know, Vic, you're out there, you're on your yoga mat with your legs crossed in a lotus position.
Oh man,
There's a cover for your new CD.
Yeah, that's right.
Well, maybe balance is that you sleep well at night.
That's
you're not
right.
worried,
Right?
Yeah, that's exactly what it is.
Yeah.
Sorry, Vic, I'm answering your question for you. Wait,
Sorry, let me do the yoga stuff on it. And taking off that vein, Steve, one of the first things you look at is that one act of balancing is actually stop buying. There's a lot of investors out there that continually look at buying and buying and buying. You need to allow the property to mature itself for it to consolidate, and that may be that one of the balancing acts is that you actually stop buying so that you're not constantly draining the equity out of your portfolio, and you're looking at the portfolio itself to be able to look after itself. Because the more properties you have, you've got to remember, it also has got a lot of admin work attached to it. So the balance doesn't just mean the number of properties and where it's bought and all that, but also what impact it has on your lifestyle as well. Yeah, and that's my deep yoga message.
I completely agree with that. And for me, investing in property is about balance. My balance is that I don't want to be doing open houses every single Saturday. I don't want to be dealing with lenders. I don't want to, balance my life out. I want someone else to sort that stuff out for me. And I think it's a component of investing a lot of people forget, because it can be stressful, can be emotionally taxing, can put pressure on relationships, financially or otherwise. So you've got work-life balance, right? They should have investor life balance.
Like Property Anonymous, anonymous or something like that. Yeah. As I suppose one of the last points is that the balance isn't this thing that you set up in the beginning and then just forget about it. It's constant. So always it's reviewing your portfolio and your position constantly, monthly, because that will give you some clear direction if you're looking at the numbers on what sort of property, where it should be, when and how as your next step, not just to throw it at the dartboard scenario or just buy.
We've got sort of quite spiritual towards the back end of
That's about as deep as I get.
It is. Get a couple of Forex golds in here, you'll probably open up a little bit more. But,
true story.
No, it's good. I've just having a chat about this organically, it's got me thinking about, balance is not about the numbers. Balance is about sort of, in many ways, your own sort of health when it comes to thinking about property. So it's good.
Want to hug it out?
Yeah, maybe. It's good. All right, ran out of time. Enjoyed the chat, guys. Remember to drop us a line if you've got any questions that you would like us to cover on the Investing Insights podcast with Smart Property Investment. You can email questions at rightpropertygroup.com.au, and I think they come over to you, Victor, don't they? So you'll get in touch. And please do send them through, because we've got plenty of topics here that we want to cover, but if there's anything in particular you think that we're missing out on, or you'd like any deeper knowledge around any of the particular points that we've spoken about today, get in contact with the guys, because they'll be happy to have a chat with you. You can go to rightpropertygroup.com.au, learn more about you guys.
Yep.
Is that how it works?
That's right. Yeah, or come to our Facebook page.
Okay.
Yeah,
And
search
you,
for Right Property Group.
So you do regular like information.
Yeah, so
sessions?
we do an open forum. We've been doing that for the last 8 odd years in New South Wales on every month, and the last one was pretty good in the sense that usually we get about over 100 people there, and the idea is that it's an open forum where we share our knowledge, and you get to rub shoulders with other investors that are doing the hard yards in terms of investing and not just talking about it. And then we do a similar thing in Melbourne as well. So drop us a line and we'll send you the information.
Okay, good. Thanks, Vic. Appreciate it. Steve, nice one, mate.
Thank you.
Enjoy the chat. That's it for us this time around on the Investing Insights podcast. If you're listening to this on iTunes, go over to smartpropertyinvestment.com.au. You can check out all the other topics that we've covered, which we sort of ran through early on in this podcast. And we'll be back again next month, where we're going to be chatting around some key principles on deciding sort of what property you should be buying. So we'll see you then. Bye-bye.